Okay, so the previous session class was terminated or interrupted due to my low connection. I'll try to go somewhere else for the next session's class. Okay, but before proceeding, I just like to give the assignments in advance. Of course, I'll post the assignment in the Canvas class. But the assignment will not have a written output. The assignment would be in the form of assigned questions for recitation next time. So I want you to prepare your answers for problems 1, 2, 3, 4, 5, 6, and 7 for chapter 1 of our textbook class. So problem 1 is mostly true or false. Problem 2 is also true or false. So I'd be asking you to answer these questions and explain to us why these statements are true or false. Then for problem solving class, as I've promised you, uh, I think starting on part 3 class, there will be open-ended problems. Well, there are also multiple choice problems. I'll give you the answers, and your task would be to come up with the solution and explanation as to how the answers should be computed or how the answers were arrived at. Okay. So for Monday, I'll be meeting everyone, and you'll be asked to answer and explain problems 1 to 7, including the problem solving. And for problem solving, your task would include to explain the solution in on how to arrive at the answers that I will be giving to you in advance. So I'll give you the correct answers for the problems, and your task would be to be able to explain how to solve the problem and on how to arrive at the correct answer. So the previous video recording class ended with the explanation as to what will happen to the acquiree class in an asset acquisition. So in an asset acquisition, from the perspective of the acquiree class, all its assets would be transferred to the acquirer, and depending on the agreement, all the liabilities would also be assumed by the all the liabilities of the acquiree would also be assumed by the acquirer, to the effect that the remaining item on the balance sheet of the acquiree would just be the cash that it will receive, assuming the consideration was in cash, would be the cash that it received from the acquirer. So total assets of the acquiree after the asset acquisition class would just be cash for whatever the consideration is, zero liabilities, and the credit would be the capital of the corporation. And of course, if on the part of the acquiree, the cash that it received is lower than its existing capital, then that means the acquiree suffered a loss, thereby reducing the capital with the amount of the loss in the exchange, which would still result in a balanced balance sheet. In the end, the total assets comprised solely of your cash would equal the capital of the acquiring corporation, reduced already by the loss or increased by the gain from the transaction. And perhaps that would be a reason, class, why the acquiree would agree to the business combination. If the offer of the acquirer is higher than the current value of the corporation, then the existing shareholders of the acquiree would be willing to give up the business in exchange for the higher price. Okay, but ultimately, the assets should still equal your liabilities and equity. Now, with just your liability, with just your cash and zero liabilities, you will now be paying back your shareholders. And as you should know already, class, supposedly return of capital following the trust fund doctrine is not allowed while the corporation is still existing. Okay? But why are we now paying back the capital contributions? Again, these are not dividends. These are already return of their capital, class. This is now repayment of capital contributions. And why is this allowed? Because we are now winding up, we are now dissolving the acquiring corporation. Okay? But speaking strictly in terms of accounting, class, what will happen in the books of the acquiring corporation? Okay? Again, what did the acquiree do? The acquiree sold all its assets and assigned or transferred all its liabilities to the acquiree. So what do? Should you hold on to these assets and liabilities in your books? The answer is no. Once your assets and liabilities are acquired by the acquirer, what should the acquiree do? They recognize everything, remove everything. So if you are to prepare the journal entry in the books of the acquiring class, you would credit all the assets to remove all the assets and debit all the liabilities to remove all the liabilities. Why are we removing or recognizing all these assets and liabilities? Because they should no longer be recognized by the acquiree because we are now transferring them to the acquirer. Okay? So you will be debiting liabilities, you will be crediting the assets, class, given to the acquirer, and if you are paid in cash, then you debit cash. So debit cash received, you debit cash in the amount you receive from the acquirer, you debit all your liabilities that were assigned or assumed by the acquirer, you credit all the assets of the acquiree to remove them from your books, and the balancing figure, class, would either be a gain or a loss. Okay? So if it's the debit side that is lacking, then definitely there is a loss. If it's the credit side that is lacking, then that means there is a gain. The cash that you receive is greater than the net assets, the net amount of your assets and your liabilities. And after that one, class, the next entry that you will have to prepare would be the distribution of the cash to your shareholders. Okay? Of course, since you are now paying the cash to your shareholders, then your entry a credit to would involve a credit to your cash. And your debit, class, would be your share capital and your share premium and all the rest of your capital accounts. Okay? So that the result would be zero for all your assets, liabilities, and equity. I always tell my students, it's very rare for share capital to be debited. It will just keep on increasing, it will just keep on being credited. Okay? The very rare instances it will get debited, class, is when the shares are retired, or in this case, class, when the corporation is being dissolved. So first entry, definitely to record the sale, class, on the part of the acquiree. This is a sale, not an acquisition. The sale of its assets and the assignment of all its liabilities. Okay? And at this point, class, you're already third years. It should not be difficult for you to grasp, class, that since you are derecognizing an asset, then the entry should involve a credit to an asset. That since you are derecognizing a liability, then the entry should involve a debit to the liabilities. And make sure, class, that you eliminate all adjunct accounts, all contra accounts, all related accounts to the assets and the liabilities, so that nothing will be left in the books of the acquiring. Okay, so after recording the sale transaction, class, the next would be to record the distribution or the return of the capital of your shareholders. Now, understand, class, that in most problems for business combination, the focus would not be on the acquiree, class. It's very rare for problems to focus on the acquiree. Okay? You will not be asked how much is the gain or loss on the transaction on the part of the acquiree. Okay? But has it ever been asked? The answer is yes. But is it a very common question? The answer is no. Because for business combination, class, our concern would be on the entity that survives. Understand that normally in a business combination, the acquiree will cease to exist. And the focus in our subject class would be on the entity that survives, or that will be the entity that will represent the combining entities. So most questions for business combination would focus on the effect of the transaction on the surviving entity, which mostly in the case of an asset acquisition class is your acquirer, unless a third entity is created to represent the combined entities. So the questions would always be, after the acquisition, how much is the total asset of the acquirer? After the acquisition, how much is the total liabilities of the acquisition? Sorry, the acquirer. After the acquisition, how much is the equity, the shareholders' equity of the acquirer? Very rare will you be asked on the effect of the acquisition on the part or on the perspective of the acquiring. Okay, but just for the sake of being prepared class, what happens to the acquiree in an acquisition? Again, all the assets will be transferred to the acquiree, and normally all the liabilities would also be assumed by the acquirer. If not, then the cash that is received by the acquiree from the acquirer will be used to pay off its liabilities before payment is made to your shareholders. Please remember your preference of claims class between the creditors and the shareholders. Who has preferential claim over the assets, over the property of the corporation? It would be the creditors. Okay, the claims represented by your liabilities. So if the liabilities will not be assumed by the creditor class, then that means the amount that will be paid by the acquirer would be very big, and it should cover the existing liabilities of the acquiring. And if there's any funds, if there are funds left class, then that would be used to pay off the shareholders. If both the assets and liabilities are transferred to the acquirer, then all that will be left on the acquirer will be cash, and the cash will now be used to pay off the claims of your shareholders. So is it possible for the acquiree to have a gain or loss arising from the business combination? The answer is yes. Okay? You get the net amount, you compute for your net assets minus liabilities, and if the consideration is greater than that amount, then that means there is a gain on the part of the acquiring. If it's the other way around, if the cash paid by the acquirer to acquire the assets and the liabilities of the acquiree is lower than the net assets, then there is a loss on the part of the acquiree. Ultimately, it will be the shareholders that will suffer the loss. Okay, but in the end, no asset will remain for the acquiree because it would be used to pay off the remaining claims of the shareholders. Okay, so going back, the focus class would always be on uh, the part of the acquirer or the surviving entity class. Okay, so let's focus first on asset acquisition before we go to stock acquisition class. I'll show you an I'll show you. I took a picture of the illustrative problem given our textbook class. I'll show it here. Okay. Uh, so in this problem class, the problem states that ABC company, which would be our acquirer class, acquired all of the assets and assumed all of the liabilities of XYZ Incorporated. As of this date, the carrying amounts and fair values of the assets and liabilities of XYZ acquired by ABC are shown below. Okay, so this illustrative problem focuses on the entry that will be prepared by the acquirer. But dealing with this before dealing with this problem class, uh, it's important for you to know that PFRS 3 expressly provides the method that will be used for accounting of business combination. And it tells us that the method used is your acquisition method. Okay. The standard also tells you as to the steps involved in the acquisition method class. And the first one being to identify the acquirer class. Okay. And although there are rare instances class in which it would be difficult for you to actually identify who the acquirer in the transaction is, but for academic purposes class, in the problems that you will encounter, you will not have a big challenge on identifying who the acquirer is. And that is especially true, class, if the problem is that of an asset acquisition. Okay? So even from this problem, class, it's very clear to us that it is ABC company that is the acquirer. Well, your textbook also discusses on various ways of identifying your acquirer class, but I leave that to you, class, since in most problems, identifying who the acquirer is not really tricky, class. It's not really a big challenge on your part. Almost always, it would be very obvious, class. You have to be very dense. You have to be very mindless, class, for you not to be able to identify who the acquirer is. Okay? But in that regard, I will just make one warning or reminder, class. The only instance in which the acquirer class becomes an issue, class, is when the transaction involves stock acquisition, class. Okay, meaning the acquirer acquires the stocks of the acquiree, and the consideration involved, class, is also in the form of stocks. So again, the only instance in the problems class in which the identity of the acquirer becomes tricky, class, is when the transaction involves a stock acquisition and the consideration involved is stocks or shares as well. Okay, even if it's stock acquisition and the consideration is in cash, class, the consideration is in cash, then that would not result in the tricky problem I am trying to describe. The tricky instance, the tricky scenario I'm describing, class, involves a stock acquisition in which the consideration involved is also in the form of stocks. Because of the arrangement, class, acquirer acquires the stocks of the acquiree, and in return, acquirer gives its own shares also to the acquiree. What's the net effect? The acquirer becomes an owner of the acquiree. But because the acquiree was given with the shares of the acquirer class, that means the acquiree also becomes the owner of a shareholder of the acquirer. So both of them are owners of one another, class. Okay? And if it so happens that as a result of the issuance of the shares of the acquirer class, it is the control over the acquirer, even though the problem is stated in a way that ABC company acquired the shares of XYZ and issued its own shares, even though it is presented that way, in which it appears that it is ABC that is the acquirer. But if the net result, class, if the net effect is that it is XYZ that obtains control over ABC, class, then that means it is XYZ that is the acquirer. So again, normally, if it says ABC acquires the shares of XYZ, common conclusion is that ABC is the acquirer because the sentence is clear that ABC acquired the shares of XYZ. But be careful, class, if in that case, ABC acquired the shares of XYZ by issuing its own shares as well. Because in that scenario, it's possible that since XYZ becomes a shareholder of ABC also that XYZ obtains control over ABC despite the problem stating nga ABC company acquired the shares of XYZ. Okay? And that is what we call as your reverse acquisition class. But again, this only happens if shares are acquired by paying shares. Shares are issued to acquire shares. But if this is not the scenario, it should not be difficult for you to identify who the acquirer is. Okay? So if ever the supposed acquiree class ends up being the one to obtain control over the acquiree, we call that as a reverse acquisition. And there's a different accounting treatment because our focus now would now be on the supposed acquiree and not on the supposed acquirer. But at this point, class, I want us to remove that from our thoughts. Forget reverse acquisition yet. Focus on straightforward type of business combination in which whoever appears to be the acquirer is actually the acquirer. Okay? And that should not be difficult for you because, again, the tricky problem we're trying to describe only happens when share is issued to acquire shares. In the example I'm showing you, class, what is being acquired by ABC here is the assets and the liabilities of XYZ. Okay? And I'm not sure if the problem shows, if the picture shows the consideration. As of this date, the carrying amount, no. Okay, so the picture, I failed to include in the picture the consideration involved. Okay, but again, since this is an asset acquisition, we should not be worried as to who the acquirer is. Now, going back to the steps involved in as acquisition method. Okay, the first thing that we're supposed to do is to identify who the acquirer is because it is the perspective of the acquirer that would be our primary focus or concern. But I failed to mention earlier, class, an acquisition becomes a business combination, class, only when the acquirer obtains control over the acquiree, either in the operations, in the assets, or even in the decision making of the acquiree. Okay, and this should be familiar to you, class, because you have already discussed previously in your past accounting subjects class the topic on investment in associates. In investment in associates, the investor invests by acquiring shares of that corporation. One corporation becomes a shareholder of another corporation. Okay, but it so happens that the amount of interest of the investor in the shareholdings of the investee is not enough to give it control, but only enough to give it significant influence. In the discussion on investment in associate class, you'd always be introduced to the level as to what constitutes significant influence and what is that area significant influence class. And you should have learned beyond significant influence, you have your control. And in that case, it will now be considered not an investment in associate, but an investment in subsidiary. Okay? So again, we will only be dealing with an acquisition will be considered a business combination only when it results in the acquisition of control. For asset acquisition class, no doubt it's going to give you control because you are acquiring all the assets and the liabilities of the acquiree. Okay? An important objective also in your reading of PFRS 3 class is for you to be familiar with the different instances in which control is. I always tell students, please do not be limited with a more than 50% threshold. It's possible for you to have control, you have less than 50%. Just like your investment in associate class, in which the standard tells you that it's possible for you to have significant influence even though your ownership interest in the investing corporation in the associate is less than 20%. You were told, class, nga, if it reaches 20% and until 50%, then your The investing corporation will be considered as your associate because you exercise significant influence. And if it goes beyond 50%, then you already have control, and that makes the investing corporation your subsidiary and not merely an associate. Okay? But again, even please do not be please do not narrow your or limit your standing class as to when significant influence or exists. Okay, in our subject, don't focus so much on significant influence. We will be looking for control. Okay, but in the problems class, in the problems, you will be the problems should always follow the more than 50%. Okay, you will only be tested on the existence of control class when the question is a theory question. But if it's a problem question class, if it's more than 50%, we are now dealing with business combination. Which leads me to my concern. For those who would only study problems class, they would come to the wrong conclusion that what is important in determining whether there is a parent or subsidiary relationship is the presence of more than 50% ownership interest. To the point that even though the problem stated that company A is control, but the ownership interest is less than 50%, that the student would already treat it not as a business combination because he or she has already programmed his or her mind that for there to be a parent subsidiary relationship, there should be more than 50%. Again, supposedly the first thing that you should look be the presence or existence of control. Okay, but if the problem is silent, that is when you will go or look for the percentage of ownership interest. Okay, please do not think that the first rule is to check whether it's more than 50% or not. No. The first rule is whether or not control exists. It's just that the presence of control is indicated by or is evidenced by having an ownership interest of more than 50%. But why would some students come up with the wrong conclusion that the primary test is the amount or the level of ownership interest? It's because they failed to read the standard class. They did not read the textbook discussion. They only referred to the illustration in the problems. Because in the problems class, almost always the ownership interest involved in a business combination would be more than 50%. Okay? But again, the first thing that you should inquire should not be the level of ownership interest, but instead the presence of control. Okay? But again, that would be more of an issue when we're dealing with theory questions instead of problem questions. Because if we're dealing with problem questions class, almost always it is indeed a business combination problem. It would be a waste of problem question when the sole purpose is to trick you into thinking that it is a business combination when in the first place it is not. Okay, but in the board exam that is entirely possible. So take away from what I've talked about for the past 5 or 10 minutes class, check first for the presence of control. If the problem is silent as to whether control is present or not, you check now the level of ownership interest acquired by the acquiree. Okay. Now, as to the second step under the acquisition method class, the second step is to identify the acquisition date. And that is important for so many reasons, class. And one of them is that the acquisition date in class for the valuation of the assets and liabilities and also the consideration involved in the transaction. Please take note that the acquirer is acquiring the assets and liabilities of the acquiree. Okay, so these assets and liabilities should be recognized in the books of the acquirer. And the question would always be, at what amount should these assets and liabilities be recorded in the books of the acquirer? is it the same amount as the amounts recognized in the books of the acquiree? Again, is the the assets and liabilities acquired by the acquirer from the acquiree to be recorded in the books of the acquirer in the amount equal to the amounts reported in the books of the acquiree? The answer is no. If we're talking about PPE, that violates the recognition principle of your property, plant, and equipment. Okay? So the rule class, as provided in PFRS 3, is to record these assets and liabilities at their fair values. And as you should already know, class, fair values are fluctuating. They change from day to day. Okay? So the determination of the acquisition date, class, is important because that would be the reckoning point in the determination of the fair value that would be used. If the acquisition happened on October 31, then it should be the fair values as of October 31 that should be used in recognizing the assets and liabilities acquired by the acquirer, class. Another reason, class, is for us to determine as to when the parent and subsidiary relationship existed, class, in case of stock acquisition. Okay? But again, if our focus is on asset acquisition, it is important for you to determine when the acquisition date is, class, is for the sake of valuation, class. Again, knowing when the acquisition date is very important for so many reasons. But as far as our discussion is concerned, class, it is most important because it would tell us the values that we would need in recognizing the assets and liabilities in the business combination. And not just the assets and liabilities, class, even the consideration. What if, no problem if the consideration is in the form of cash, its fair value is always equal to its face amount. But what if the acquirer exchange its own property? So the valuation of the consideration would also be reckoned from the date of the acquisition date. Would be reckoned from the date of the acquisition, or which we refer as your acquisition date. What if the consideration is in the form of shares? What does the standards on share-based payments tell us? That it is also to be measured at fair value. And again, we need the fair value on the date of acquisition. Another takeaway, class. It's always my advice to students uh, to make it their goal to gradually and continuously expand their stock knowledge. If there's takeaway from today class, from tonight's discussion, it's that the assets and the liabilities and even the consideration, class, are to be measured at fair value. And this rule, class, is very important later on in our discussion on goodwill or gain on acquisition. Okay, and the third step, class, and the third step is on the determination, the recognition and measurement of goodwill. Okay, uh, I'll discuss goodwill in a bit. But going back to the second step in the acquisition method, class, the determination of the acquisition date is also important, class, because point from the expiration of our adjustment period. In business combination, class, we allow provisional valuations. Again, how are assets, liabilities, and uh, it should be measured at fair value. And as to what fair value we are going to use, it is the fair value in the date of acquisition. But because it's not possible to immediately know all these valuations, class, on a single day, the process of business combination could take months, class. Okay, so since it's possible for the determination of fair value, class, to take a significant amount of time, the standard allows for an adjustment period of 1 year, measurement period of 1 year. Okay, within that measurement period, class, There may be adjustments to the fair values assigned to the assets and liabilities involved in the combination may be adjusted. Okay? And the measurement period class is only for 1 year. And the 1 year is reckoned from the date of acquisition. So that's another reason why it's very important for us to determine when the acquisition date is, because it tells us what fair value to use, and it is the reckoning point for the expiration of the measurement period. So even though you've recognized these assets already in the date of acquisition class, these are within the measurement period. And if there is adjustments to the assets and liabilities recognized in the business combination, then there will also be adjustments on the resulting goodwill or gain. Okay. Now focusing on the third step class, which is the recognition and uh, measurement of goodwill. I always explain it this way, class. So even from the first year, even in the discussion in intangible assets when you were still in first year in conceptual framework and accounting standards class. The first thing that I tell students regarding goodwill in the discussion on intangible assets class is that goodwill will only arise from a business combination. Okay? Goodwill only arise in the case of business combination. And I explain to them as to when goodwill will arise. Okay? So there will be goodwill class. There will be goodwill if the amount paid by the acquirer, the consideration given by the acquirer, exceeds the value of the assets and liabilities acquired. So to oversimplify the point class, the acquirer paid 1 million. The acquirer paid 1 million pesos. Okay? And the 1 million is paid to acquire the assets, the net assets of the acquiree, where the value of the acquiree, the net assets of the acquiree is only 800,000. Okay? So when we say net assets class, this is your assets less your liabilities. This is equivalent to your equity. But again, remember that the assets and liabilities of the acquiree is to be valued at fair value. Is to be valued at fair value. Okay? So the assets and the net amount of the assets and liabilities of the acquiree class already measured at fair value, is only 700,000. If you individually sell the assets and you individually pay the liabilities of the liability of the acquiree, you would get a net amount of 700,000 because that is based on their fair values. But here comes the acquirer class. Here comes the acquirer. The acquirer is willing to pay 1 million. The acquirer is willing to pay 1 million class in exchange for assets and liabilities that could have been sold or disposed in the amount of 700,000. I hope you get the scenario class. Individually, if the assets and liabilities were disposed of class, the net amount would be 700,000. Okay? But here comes the acquirer. The acquirer is willing to acquire these assets and assume these liabilities by paying 1 million, by paying more than the value, the fair value of the assets and the liabilities. Okay? And you ask, and the answer is, and you ask the question why. Okay? On the part of the acquirer class, you would think that this is a loss on the part of the acquirer. You have 1 million here and you're exchanging your 1 million peso for assets that are only worth 700,000. In our dialect, we would say, okay, the acquirer is willing to pay 1 million for assets worth 700,000 only. Okay? If it was the other way around, class, if the value of the assets were 1 million and the acquirer only paid 700,000, how would we describe the transaction class? We would say that the acquirer had a gain in the amount of 300,000 because the acquirer acquired or received assets worth 1 million in their own right, worth 1 million, but the acquirer only paid 700,000 for it. So nakasave or nakaginansya si acquirer. Okay, but in my example earlier class, it's the acquirer who pays 1 million in exchange for assets that are only worth 700,000. That are only worth 700,000. If ganina, we saying earlier we say that the acquirer had a gain because he acquired assets at a price lesser than the value of the assets acquired. In this case, it is understandable if we are to think that there should be a loss on the part of the acquirer because the acquirer is paying more than the value of the asset acquired. But the standard does not tell us to recognize a loss. Instead, the standard tells us to recognize an asset, to recognize an intangible asset. And what asset would that be? Recognize goodwill. So there will only be goodwill class if the given is greater than the value of the assets that are acquired, is greater than the fair value of the net assets acquired. Okay? So it might go against logic and good judgment class. You're paying more and you're not even recognizing a loss, but instead you will recognize another asset. So what would be an explanation for that treatment class? Why is the standard telling us not to recognize a loss, but instead recognize another asset? Even though from our judgment, we are of the opinion that the acquirer is on the losing side of the transaction. And instead of recognizing a loss, we are telling the acquirer to recognize an asset. What's the explanation? We can see, you can look at it this way, class. The acquirer for the assets of the acquiring class. And the only reason that the acquirer does that class is because he is not crazy, class. Had the acquirer been crazy, then it would make sense that he would pay more for assets that are not worth as much as the consideration, not worth as much as the payment. But because we assume that the acquirer is not crazy, class, we have to justify why is the acquirer paying more. The reason, class, is that the acquirer sees something in the acquiree that is more than its individual values, class. We assume that the acquirer is not crazy and that the reason the acquirer is willing to pay more is that the acquirer sees something in the acquiree that makes it worth more than the individual values of its assets and liabilities. But the problem now is, what is that something? What is that something that the acquirer sees in the acquiree? Is it an asset that you can see? Is it an asset that you can sell? The answer is no. But is there really something in that acquiree? The answer is yes, because we believe that the acquirer is not crazy. That the acquirer is only willing to pay more because it sees something in the acquiree. Can we also see it? Perhaps not. But we believe in what the acquirer sees in the acquiree. And that is essentially your class. If you can remember the definition of your goodwill in your intangible assets class, past 38, a goodwill is an unidentifiable intangible asset. It is an asset, but it's not identifiable. And if you remember your definition for intangible assets class, one of the elements of an intangible asset is that supposedly it it should be identifiable. But as an exemption, we allow the recognition of goodwill even though it is not identifiable, class. Okay? So goodwill really is something in the acquiry class that we cannot see, uh, that we cannot substantiate, but we firmly believe to be existing in the business if taken as a whole. Okay? So that's why goodwill will only arise in a business combination when the business is taken as a whole. Individually, they're only limited to their fair values. Okay? And just because someone believes that the acquirer is worth more than the values of its assets and liabilities, then we allow the recognition of your goodwill. So I hope I'm able to illuminate on the reason why there will be goodwill. Okay, and I hope you understand as to why it's possible for us to recognize a gain. When is there a gain? There is a gain if the consideration given there is a gain if the consideration given is less than the value of the assets acquired, and that should make sense. You are getting more than what you are paying for, and that essentially explains why you have a gain. On the other side, class, supposedly we would say there is a loss if you are paying more than the assets that you are acquiring. But because we assume that the acquirer is not crazy, class, we assume that the acquirer is not crazy, uh, we will loss, but recognize goodwill to represent the something that is seen by the acquirer, that is present in the eyes of, that is present in the acquiree, as seen from the eyes of the acquirer. It may be a result of an established business operation, class, or brand or image. Okay, but basically, the reason why we do not recognize a loss but instead recognize a goodwill is that the acquirer sees something in the acquiree, that the acquirer believes that the acquirer is worth more than the aggregate individual valuation of its assets and liabilities. And I believe we can stop here for tonight class. So just a run through of what should be your takeaway from tonight's session. I like to show a problem I use to illustrate business combination class. Okay, so in business combination problems class, it's possible that you would be given two sets of balance sheets as of the date of acquisition. You'd be given the trial balance for the acquirer and the trial balance of the acquiree. And as you can see in this problem class, uh, you have two columns for both the acquirer and the acquiree class. One column for book value, another column for fair value. Now, for your takeaway for tonight class, remember the valuation class. As I mentioned earlier, remember that the assets and liabilities of the acquiree are to be measured at fair value. Okay? But as for the acquirer class, you will have to ignore the fair value given on the part of the acquirer. Okay? The need for fair value is only present for the acquirer class because it is the assets acquiree. It is the assets and liabilities of the acquiree that will be transferred to the books of the acquirer, and they are to be recognized in the books of the acquirer at their fair value. Whereas the existing assets of the acquirer will remain at whatever their book values are. So again, first takeaway for tonight, liabilities of the acquiree are to be transferred and recorded in the books of the acquirer at fair values. So between these two columns for company B, as our acquiree class, you ignore the book values class, and the only valuation relevant is your fair value. Okay? Because the book value is irrelevant for the acquiree, the relevant valuation for the acquiree is your fair value. Now, for your acquirer class, please don't have the mindset that just because it's given in the problem, it means that you will have to use it. Okay? Sometimes it's given there just to confuse you. For the acquirer, you will ignore the fair values given for the acquirer because no revaluation, no change in the valuation will happen for the uh, acquirer. But why will problems give you the information also for the acquirer when the need for valuation is only for the acquiree? Most problems will give you the trial balance for both the acquirer and the acquiree class because the common questions for business combination, especially in an act, is for the amounts after the combined amounts after the uh, combined amounts after the acquisition. Supposedly, if you're looking for the combined accounts receivable, what are you supposed to do? Just combine the accounts receivable of the acquirer and the accounts receivable of the acquiree, because the acquirer is just getting the assets of the acquiree. So if the problem asks you how much is the combined or consolidated accounts receivable of the acquirer immediately after the combination, since it's after the combination class, you already include the accounts receivable of the acquiree. And how do you solve for that kind of question? Very easy, class. Just add accounts receivable of company A and accounts receivable of company B. But be careful at what amount should you add the accounts receivable of company B, the acquiree. Again, it should be at fair value. How about for company A? If it's the acquirer class, ignore the fair value. You stick to the book value. So the AR of company book value plus the AR or the accounts receivable of the acquiree at fair value. Okay, so again, first takeaway, measure the assets and liabilities of the acquiree at fair value. Whereas when you're asked for the consolidated or combined amounts immediately after the combination, all you have to do is to add the balances from company A and company B. Remember that company B, the amounts from the acquiree should be at fair value, while the amounts from the acquirer should remain at book value. We'll discuss this problem more later on, class. Okay, but just as a so that would be your takeaway. Second, that would be your first, second, third. I lost count already. Your takeaway for tonight, class. Please do not forget also the importance of the acquisition date. It tells us the fair value that is relevant, and it serves as the reckoning point of the duration of the measurement period. Uh, Perhaps in the next meeting lang, I'll discuss the why uh, goodwill will only arise from another reason why goodwill will only arise from business combination and why it will other forms of acquisition, class. Okay, so as a final reminder, please prepare your answers for problems 1 to 7 from the textbook, as that would be the coverage of your recitation